look at the term demerger. Demerger, and you say that demerger refers to split of an entity into smaller legally separate entities. It refers to split of an entity into smaller legally separate entity. You know, when you merge, you are taking a complete company, like I said, A Limited, you add it with B Limited. So you have whatever product that can be C Limited, right? So C will be having, maybe this one had got like an asset base of 20M. We have asset base of 30M. You are going to have a product with asset base of 50M. After consolidation, when they are now combined together, that is a merger. Now in the merger, you are doing the reverse, the opposite. So initially you are having a C Limited, but then you take C Limited, you split it into two so that you have C1 and C2. These are independent and legally separate entities. Legally independent, separate entities. Are we together? Now, that is where we are. So we are saying that a company can be splitted to have two or more separate entities, and that is called demerger. What are the advantages of demerger? Advantages of demerger. For those who are joining now, Jen, welcome. We are looking at the term demerger, and we've said that demerger is where a company is split into two or more legally separate entity. You take a big company and split it into two or more so that each company becomes separate and legally a separate entity. The advantages of splitting the company into pieces and have them run separately. Number one, it enables the management to have control of the small entities. It enables management to have control of the small entities, the independent, legally separate entities. So if we have, for example, if we have, let's say that CFC Stanbic Bank. CFC Stanbic Bank was separated or split into two, so that now we have the Stanbic Bank, and then we have CFC separate. So these are two companies. Initially, those who can remember, back then we used to have separate one big company called CFC Stanbic, but right now we have Stanbic. It was splitted, and that is a good example of demerger. Now Stanbic can operate itself separately and the other one also. So that means that management of Stanbic will now have more control on their own entity. So I'm saying that the first advantage of this, Topista, welcome. The advantages of demerger. Topista, we say that demerger is where companies separate, or where big companies separated or split into smaller entities which can be able to operate on their own. The advantage of this, number one, is that there will be more control. The management will have more control on the smaller and separate entities. That is number one. Number two is that smaller units are able to focus on their core businesses and perform better. The smaller units can be able to focus on their core businesses and perform better. So an example is when we are having, for example, let me say Equity, or even Safaricom. Safaricom could be having the M-Pesa section and also they have the normal telecommunication line. If you separate the two, it means that now the management will have control on M-Pesa. We don't now have a one CEO. We'll have separate CEOs who are able to operate their own entities separately. So that will be ensuring that there is more control on M-Pesa business and also on the telecommunication. Number two, each body or each entity will have more focus on their own areas of operation. So we are saying that the small entities will focus more on their core businesses. They will focus more on their core businesses. The next thing you can say is that it facilitates separation of risk or risky activities. It facilitates separation of risky activities as part of risk management. So as a way of managing risk, when you split them, you are basically separating or reducing risk in the bigger umbrella. So if it is non-compliance, for example, if one part of the entity or one small entity is not complying, the other one is complying, it is only the one that is non-complying that will be able to will lose their license, all right, or will have problems in operation. So you don't close the whole business because of one entity's mistake. You don't close the whole business because of one entity's mistake. So we are saying that it helps to facilitate separation of risk or division of risk of risky activities as part of risk management. It helps separate risk as part of risk management. The next one, it helps in enhancing survival of profitable divisions. It makes profitable divisions survive. The profitable division can be able to survive. The ones that are not making profit can go down. So it helps to facilitate, it helps to enhance or facilitate the survival of profitable division. The survival of profitable division. The survival of profitable division makes the profitable division survive. It helps in enhancing survival of profitable division. The next thing is that small entities, that last one I say that it helps in enhancing survival of profitable division, full stop. The next point, which is point number 5, the small entities may suffer lower taxes and also receive incentive from the government. You know, sometimes the small entities will be looked at as SMEs. And you know, the government sometimes come with policies to support SMEs. So wakati niko na kampuni kubwa, I'm not considered to be under SMEs. So I cannot benefit. All right? But when the government is giving incentive to SMEs, and I happen to have splitted my companies into smaller entities, they can take advantage of that and benefit, because the SMEs now benefit from the incentives. And so I'll be in that category, or probably all my companies. Let's look at limitations. So that point, Florence, I can repeat for you. It says that small entities may suffer lower taxes and receive incentives from the government, So are we okay there, Mary? Mary, are we okay? The first point was not clear, right? The first point I said that it enables management to have more control of the smaller entities. By splitting them, the management for each smaller entity will have more control on each. And I gave example with Safaricom. If Safaricom was to separate the M-Pesa business so that it is a different company, it will have CEO, operation manager, finance, ICT. So even the reporting and the controls will be better than when they are over the bigger umbrella, where the CEO is looking all over. Now, the next one, we look at the disadvantages. And I want to say that the first disadvantage that it might increase the cost of overhead due to duplication. It might lead to an increase in the cost of overhead. It might lead to It might lead to an increase in the cost of overhead. It might lead to an increase in the cost of overhead. Might lead to an increase in the cost of overhead due to duplication. Right? Due to duplication. The next point you say, it reduces borrowing capacity. It reduces borrowing capacity. It reduces borrowing capacity. It reduces borrowing capacity. It reduces borrowing capacity compared to when it is a large entity. And guys, remember, I requested that you make good notes. I will be able to take them from you, right? So Ruth, kindly make good notes. I'll be able to take them from you. The same to Jen. And everyone else. Just make good notes. I'll be able to buy them from you. Not for free, but I'll buy them. So attend all classes, please have good notes as well. Okay, so we can proceed. I said that by splitting the companies, it reduces borrowing capacity compared to when it is a large entity. Number 3, you say that it might result into loss of economies of scale. Can lead to loss of economies of scale. Might 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 lead to loss of economies of scale. Because if you are a big entity, that is the beauty of having a big entity. So if you are not big anymore, then the advantage of economies of scale is not there. So I want us now to look at an example. Of mergers and acquisition question. But before that, there are things that we need to look at that you need to get used to. The first one is called EPS. This one refers to earnings per share. So EPS is equal to total earnings over total number of shares. This one is also equal to market price per share. Now it is equal to earning per share. It is equal to just normal earnings over normal number of shares or normal shares. So sometimes they can give you the total. Sometimes they just mention that the earnings is this and the shares are this. So EPS basically means total earnings, or basically earnings all over the shares that you have. Now, normally when a company is trading, we normally have the gross, or we have sales, which can be a certain figure. Then we have the cost of sale, can have there. Then we have fixed cost, can have there. Whatever we're going to have here is the gross income, right? Gross profit. Now, on this gross profit, we need now to less our, depreciation, probably. You might also less interest on loans. Then you will have profit after that. That is profit before tax. On this profit before tax, you should be able now to less tax, which will be a certain figure. Now we call it profit after tax, or PAT. So our total earnings is the same as profit after tax, or sometimes we call it net profit, all over total shares, number of shares, all over total number of shares. So what we are interested in is the final profit after you deducted all expenses. This one, we call it profit after tax. It is also the same as profit attributable to ordinary shareholders, which in other words we call PATOS. Profit attributable to ordinary shareholders, PATOS. Now this profit, it is what the ordinary shareholders are entitled to. Like now we are having SACCOs declaring dividends. They normally declare dividends on the income that they have received. That particular dividends can either be retained, which we call PATOS, or profit after tax. You either retain it or pay off as dividend. But both dividends and retained earnings are all earning to the ordinary shares or shareholders. Yani hii pesa unaweza gawa hivi mara mbili, ingawa utaigawa hivyo, bado itabaki pesa ya wenyewe, pesa ya mweka hazina, sio? The shareholders. So what we are interested on is not in the retained earnings only, or dividend amount that was paid as dividend only. We are interested in the total amount. That is what we are having here. So you need to calculate whatever form the examiner can give you. You need to calculate and reach here. That is when you can now call it the earnings. Now in your instructions, you'll be given the total earnings, but some examiners might call it total sales, or they can call it earning per share. They can call it earning per share. So if you have earning for one share times the number of shares, you'll get total earnings. So let's look at that. If you are told that you have earning per share times the number of shares, it is going to give you this. So it is basically cross multiplication. So we are saying that total earnings is equal to EPS, that is earning per share, earning for one share, times the number of shares. We can also get total number of shares. It is basically exchanging this with this so that we have total number of shares being equal to total earnings all over earning per share. Earning per share. Now, these formulas are very important so that you can work with whatever you're given. You need to understand them. Now, when we are merging companies, we are merging companies because one of them has a problem. Most likely, one has a problem. Or we are acquiring because one has a problem. Or even both. But in most cases, one has a problem. The one that's being acquired, the target ndio iko na shida, si ndio? So you might find that two companies are merging or one is acquiring the other, whatever term they will use, the most important thing is that they are coming together. So we have company A limited and we have B limited. We have earnings or total earnings of 10M. We have, or let me just call it Kubwa limited. This one is Ndogo limited. Sometimes they call them name like Shida limited. And this one is called Furaha limited. They can give any name. So this one is 5M. They are telling you that the EPS, earning per share, is given here as maybe 4 shillings. And here is 2 shillings. They are telling you this one, let me just say that earning per share is here is so this one can be 20 million. Earning per share is 4, earning per share is 2. They are telling you that the market price per share, MPS, is equal to maybe is like 15, and then this one is 9. If they use the word market price per share, what does that mean? MPS is the total market value, total market price, which is the same as the value of the company. You know, the total market price of the company is the same as the value of that company in the market. So it is the total market price all over per share, all over total number of that one we are looking at the total and total. You can also get MPS by looking at the price per share. So we have price per share all over the number of shares, all over the shares. So it is price of one share all over the share. That one is also applicable. So you need to understand that MPS basically means that total market value all over the total number of shares, or the price all over shares. And that is why we call it price per shares. So in the question, the examiner can call it MPS and then they give you value. You should know that this MPS can tell you the value of the company. You simply know that MPS is equal to total market value over total number of shares. So from here, Mary and Mercy, from here, if the examiner asks you to get the number of the value of the company, what we call market capitalization of the company, that is the market value of the company, the same as market capitalization of the company. You simply multiply this and this. You say value of the company is equal to MPS times number of shares. This one here. Multiply this. This one is going to give you the total value of the company in the market, or what we call market capitalization. I hope that that is clear. Henry, are we together? Are we together, Henry? Now, on this, you can be able to see something like this. Once you are able to identify which company is the predator, that is the one that is going to acquire the other one. So it is called predator or the acquirer. You need also to identify the target, the one that is being acquired is called the target. It is being targeted, it's going to be acquired. Then most likely, the targeted one, which is the target, is the one that has got problem. Hii ndio inakuwa na shida. Ndio maana inafaa ichukuliwe. Hii ndio iko na shida, and when they are merging, they will most likely kill this one, they remain with this. So it is being acquired. Kubwa itakula ndogo. Now the implication is, when these guys are coming, and probably the examiner can tell you that number of shares, maybe here is something like, maybe, let me say, 1 million or 2 million. Those are informations that you can be given. 2 million, these are the number of shares in this company, and here we have 1 million. One thing that you can be able to see is that what the directors are interested in. Remember, the shareholders are the ones who are going to lose or gain. Shareholders are the ones who will approve whether the company can be taken or not. And that is why yesterday, when we were looking at the ways of avoiding acquisition, one of them was persuasion. The management can persuade the shareholders not to accept and tell them that this activity that we are about to undertake of acquisition is not in the best interest of your investments, or is not in your best interest. So the management will convince shareholders so that they can vote against acquisition. So the most important people in acquisition are shareholders. So you need to know how many shareholders are we having in each company, and how much are they earning right now. The shareholders' interest is on the earning for each share. Kila mtu ako na share, lakini anasema share yake moja, tuko na total of 20 million, lakini unapata mtu ako na kama 5. Anasema hizi 5 nikiwa nayo is going to give me 5 times 4 is going to give me 20 shillings. Lakini hawa 5 itakuwa 5 times 2, which is 10. Who is gaining? You can see that the Kubwa Limited has got more value than Indobo Limited, which is 10. So therefore, the most important part for them is how much does a share earn? How much are they going to earn? Are we going to have 4 or 2? If we have 4, good. If we are going to have 2, we are losing. So when a company is being acquired, they are looking at the value of each share. They are looking at the value of the market value, the market price for each share, how much they can sell the shares in the market. Huyu akiuza anauza at 15. Huyu anauza at 9. It means that this company, the dividends, the return is low, 2 shillings, and the market value is also low. I hope that you're getting the interpretation. So hawa hawako poa, hawa ndio wako sawa. So if they are going to mix, and let's say that the total earnings here, we are having EPS, and you see these things must make sense. Tuko pamoja? Yes. So for us to have EPS here, it is a total number of shares. So the EPS should be, if this one is 2 million, then EPS is 10, because it is total earnings over number of shares. So this one should be 10 for it to make sense. And then this one divided by this one should be 5 for it to make sense. So that is how it should happen. So look at the question keenly and check if you can understand what they are doing. Sawa sawa. Usianze tu kufanya hesabu na hujaelewa. The EPS must communicate something that is earning per share. So it is 20 all over total number of shares. Total number of earnings all over total number of shares. And that gives you 10. That is why it is called earning per share. Also the same side, on this side, we have total number of earnings all over total number of shares, which is 5. Then that question makes sense. So you can see that their EPS is a result of this and this, division of this and this, right? Now, you can see that the EPS is lower here, but here is high. If we happen to come up with an agreement and merge the companies, our total earnings will be the new earnings after merger will be earning for A or kubwa plus earning for ndogo. Our total earning will be 20 plus 5. That is 25. But at that time, we have taken all the shareholders here, wamevuka. So they are now having their shares here. So we have added 2 plus this. That is the total number of shares. So our new shares will be 2 plus 1, which is 3. So the new EPS should be 25, which is this one, divided by the new number of shares, which is this. That will give you 8.333. If the agreement to merge the company is going to make anybody lose, they might not be happy. If kubwa, shareholders in kubwa allows the shareholders of mergers of ndogo to merge at equal ratio, that every share you have here, we shall allow you to bring it here in its equivalent value. Yani kama ulikuwa na share moja hapa na umekuja kwetu, you will still have 1 share. That is a ratio of 1 to 1. Unaelewana? Wacha hiyo kampuni yenyu ikufe. Ishakufa, when you come to our company, if you are having 1 share, we shall give you 1 on our side. So that is a ratio of 1 to 1. That ratio is going to make the total number of shares to be 3 million and the total number of earnings to be 25. At the end of the day, we are going to realize that our new EPS is going to be 8.3 and not 10 as it was initially. The directors of Kubwa Limited, who have the powers to allow acquisition, will not accept. Watasema, hiyo mchezo itapaja to lose. The value of our shares or the earning for each share will go down. We cannot allow, because that is their main interest. And that is why I was emphasizing that the main interest is here. Kwa hivyo watakataa, kwa sababu wameona hiyo mchezo ikiendelea watalose. Of course, these guys will be happy. Initially they were earning 5. Sahi sasa wanapewa, watakuwa na earn 8. So that is an increment. They will be happy. What has basically happened is that we have diluted the earnings. Earnings yenye tuko nayo, tumekuwa na so much shares that tukigawa, tunapata kila mtu anapata kadogo kadogo. So that is what they don't want, dilution. We are going to dilute the shares or the earnings. Ni kama umepika chakula kidogo, watoto wa jirani wamekuja, inabidi sasa uongeze maji kwa supu. Kama ni supu ya omena, itapoteza ladha. Ama supu yote tu, it will lose that taste. So that dilution, because now the shareholders are so many, you have to find a way of giving each, is what the shareholders will not accept. Therefore, this brings us to a term that we call non-diluting ratio. We now need to agree that even though we are going to take over ndogo, sisi kama directors of Kubwa, even though we are going to take over ndogo, we need to agree in a ratio that is not 1 to 1. We need to look for a ratio that will not make us lose the value of our earnings, will not make us lose earning per share. That ratio that can allow us to still retain the value of each share is called non-dilutive ratio or non-diluting exchange ratio. Non-diluting exchange ratio. It is the ratio that will make us at least maintain what we used to earn before the merger. Are we together? Hiyo story imeingia mabado. Florence. Hiyo story iko aje? Umeipata? So bado haijaingia. So we are saying that non-diluting ratio is the ratio that will make sure that the value or the earning per share does not go beyond what we were having originally. It will make sure that we don't lose. So the people who are concerned ni hawa. Juu hawa ndio wata lose when this company that was weak joins them. So you understand what we call non-diluting ratio? And therefore, in that case, we also have non-diluting offer price. Remember, the price per share was 9. That is, when we are taking dogo, we shall buy each share as per the market price. Tunasema, we are buying you and all your shares tutachukua as per the market price. If we realize that we are going to pay more, in such a way that the price or the value of our shares will go down, hatutakubali. We are going to lose. And that is why yesterday we learned about some of the reasons why mergers fail. Overpricing or high cost of acquisition. Yani umeacquire at a higher price that you cannot even make any business with it. So when we realize that we're going to acquire at a higher price, we have to agree with them. Okay, we shall buy you, but not at 9 shillings. Let's agree on a price that is quite low so that we are not going to lose. That price that will make us not lose, that will make us still have some profit, is called non-diluting offer price. It is the minimum amount that we can pay, or we can say that is the maximum amount that we can pay, beyond which we don't accept. So ukituambia if non-diluting offer price is 9, lakini wewe unatuambia unataka 10, ati we pay you 10 ndio tuweze kuchukua huyu, tunakataa. Because if we take at 10, we are going to run at a loss. So the maximum amount that we can pay you to be able to maintain or remain afloat is now the non-diluting offer price. It is the best amount that we can pay you, without which just go with your company. We don't want. That is who we are talking. Who is talking. We can't pay you beyond that. The maximum that we can pay you, that amount is called the maximum exchange or maximum offer price. It is the non-diluting offer price. I want us now to look at the terms again. We have talked about the non-diluting exchange ratio, non-diluting offer price. I want us now to also talk about post-acquisition EPS. After, post means after, right? So post-acquisition EPS is the EPS that comes after acquisition. Let me now put them down. So post-acquisition EPS it is the total EPS, which is the EPS for, and no, not EPS but earning. Remember, EPS was total earning of our number of shares. So it is the earnings for A, which we call maybe for 1, plus earnings for company 2. That is the summation of the total earnings for the first one and the second one, all over number of shares of the first company, that is the acquired, plus the number of shares of the company that is being acquired, which is the second company. But we don't take them fully the way they were. If we take them fully the way they were, we are going to lose through dilution. So we are going to tell them that we shall take at a certain rate. Therefore, we multiply this with the exchange ratio that we shall agree on. So it is the second company that is being acquired that you multiply with the exchange ratio, because we can't allow to add our 2 million with 1 directly. No. We will say that we can't allow you take all your shares to our company. For every 1 share that you have, we shall give you a certain amount. Kama unavuka na walikuwa na 1 share, huku ukikuja kwetu tunakupea half. In that case, the exchange ratio is half. So we shall multiply this with a half. So that we are going to have 2 plus 0.5, which is now 22.5 M. It means that for every share that you are having in company A or B, ukivuka unakuja na nusu. Kama ulikuwa na 2 huko, kwetu tutakupea tu 1 peke yake. So that is the exchange ratio that we have agreed on. So you multiply the number of shares that you are having with the agreed exchange ratio. That is the post-acquisition EPS, how you can calculate it. We shall be able to see more. We talked about the maximum exchange ratio, the maximum that we can allow. It is also called non-diluting. We say that is non-diluting exchange ratio. This one is equal to, it is equal to non-diluting offer price non-diluting offer price all over MPS of the creditor. All over MPS of the creditor. So what we are saying is that exchange ratio, this one is just the term exchange ratio. Forget about the maximum. Just take the word exchange ratio, which we talked about here. How do we get exchange ratio? Exchange ratio is equal to the market price of market price per share, yani market price of 1 share of the target all over market price per share of predator. That is the normal exchange ratio. That is how they can exchange. But if we realize that this exchange ratio can give us a loss, then we don't take the market price as it was. Remember, it was 9. Hatuwezi kubali 9. Tunatafuta ile haitafanya to dilute our shares. We agree on the market price or the price. Remember, the one that we are having in our example that I gave you was 9 for kidogo or ndogo. Ndogo ilikuwa na 9. Lakini tukirealize hii 9 italeta shida, we are now changing it to the one that cannot make us have a problem. We have to agree on it, the maximum that we can offer. That maximum that cannot dilute our shares, we call it the non-diluting offer price. It is the offer price that if we pay, we shall not dilute our shares. Now, if we have agreed on it, if we can agree on that value, then you put it over the normal market price of the predator. That exchange ratio that we are getting is not just an exchange ratio. It is not just an exchange ratio. It is now an exchange ratio that will not allow dilution. So non-diluting exchange ratio is gotten by having non-diluting offer price. Like in any other normal exchange ratio, the normal exchange ratio is just the exchange ratio is equal to of the price all over MPS. MPS of target all over MPS of the credit. This one that does not, the one that does not allow dilution, we are saying that is the maximum that you can allow. It is the maximum that you can allow. So it is also the same as maximum offer price. It is the maximum amount that you can allow. Maximum offer price. Ile pesa mingi tunaweza kubali kulipa. So maximum offer price is the same as the non-diluting offer price. It is the one that can allow us to exchange without losing the control, without losing the value of our shares. EPS is very important. Listen carefully. Yes. So Florence is asking, hapo ndio non-diluting offer price ratio comes in. Yes. Non-diluting offer price of any ratio, exchange ratio, comes in when you have used the maximum offer price, the best that you can offer, beyond which utakataa. Yani ile pesa mingi unaweza lipa, ikizidi hapo unakataa, hautanunua hiyo. That is called non-diluting offer price or maximum offer price. That is the maximum amount that the predator is willing to pay for one share of the target all over the number. Yani wana compare, wanasema how much do we have currently? Sisi market price yetu ni hii. Lakini wewe unataka tukupe ngapi? They are going to look at it. If that one is going to make them lose, it is not the maximum. The maximum is the one that beyond which they can lose. Below is okay. They can allow anything below that because they are buying at a cheaper price. Anything below that is okay. But beyond that, they don't allow. So the one that acts as the limit is now what we call the maximum offer price. That term needs to get into your head very fast. That term needs to get into your head very fast. Hapo kwa non-diluting. Any other question? Hiyo post acquisition. You are not understanding everything, and I'm seriously confused because the term seems to be the same. Why are they the same? What if post acquisition inafanana na maximum offer price? How are they the same? Professor hata ame left. Watu wako na confused here. Lawrence, I've already described two terms. Post acquisition, which I told you how to get it. You need to get, post acquisition EPS is just the total number of earnings when you combine the two together, all over the total number of shares. When you take the number of shares of the predator full the way they are, because hakuna exchange hapo, plus the number of shares of the target times the exchange ratio. You are saying that what is non-diluting offer? See, inakaa kama the same as exchange ratio. Itaingia tu, don't worry. Tell those who have logged out to come in. Jen, come in with your colleagues. Bado kuna maneno hapa. Usiogope, usitoroke. Let me start again. These terms, if you don't get them, I'm telling you, you will get more confused in exam room. Hakuna kitu mbaya kama ume-miss direction. Ni kama thinker, umeambiwa that you need to branch on the first exit. Lakini wewe uko katikati unaenda. Utapatikana huko first. Inaitwa Jeruiru. Lazima ujue which lane do I need to exit. Ama unaweza branch na sasa umeenda tu place zingine tofauti. Patikane kidogoro huko. So we are saying that there are terms that you need to understand. The first term is called earning per share. It is the earning, total earnings all over total number of shares. That is for one company before we merge. For one company before we merge, just write the total earnings over the total number of shares. If we merge the companies, remember we are having A Limited operating in Kariobangi and B Limited operating in Kajiado. the two companies will continue in operation. There is nothing that will affect their income. Tunaelewana? Yani one company inaendelea kufanya tu kazi. The only thing that has changed is the ownership. Kazi inaendelea. So the profit is still the same. We will maintain the profit. The only thing that we're going now to reduce is the shares. If the one in Kariobangi was being owned under 1,000 or 1 million shares, and it is being taken over, the people who are buying it will refuse that. Sisi kama unakuja kwetu, hatutakubali ukuje udemand that you own one share in our company. Kuja polepole kwa sababu kampuni yenu iko na shida. So kuja polepole. Hii yenu iko na shida. Kama ulikuwa na mbili, hapa tutakupea tu moja peke yake. If you don't want that, quit. Tunaelewana? Because already the one that is being acquired iko na shida. So the predator wanaweza anza kuringa, wanaweza ringa waseme kama unatoka huko unakuja kuja polepole. If you thought that you had so much shares hapo, sisi hatutakupea mingi. If we give you more, you're going to gain a lot from us. Na sisi ndio tumefanya kazi all these years mpaka jina ya company imekuwa vile iko. So what you do, for every share that you are having there, we are going to give you only one. Or we are saying, yeah, so unasema sasa hiyo ndogo inaona. Okay, so we are saying that for every, yes, hiyo ni kubwa ndio inaongea. Wanakuambia nyinyi watu wadogo, if you are coming, kama ulikuwa na shares kama mbili huko kwako, hapa kwetu ukivuka ukuje kwetu, we are going to give you only one. Okay, Florence, let me go back to something that you are taught in Nepal. You are taught about reconstruction. In reconstruction, we are saying that there are situations where you can have internal reconstruction. In internal reconstruction, you agree with the shareholders that tuko na shida, we are going to reduce the number of shares. So you can be able to do what is called merging. You merge the shares. Splitting will increase the number of shares because kama ulikuwa na mbili ukisplit utakuwa na mingi. So we are saying in this case, for every 2 shares that you are having, we are constructing shares. Kama ulikuwa na mbili pale, we can allow you to purchase, come and buy shares from us so that you don't lose. Badala ya kuenda nyumbani ama upoteze everything, we allow you kuja hapo ununue shares. Lakini kama ulikuwa na mbili pale, we are going to have what is called share to share exchange. Sio ulifunzwa? Ulifunzwa hiyo share to share exchange. We are not giving you money. Just come and take shares from our side. So uko na mbili in Novo Limited. Uko na shares kama mbili in Novo Limited. And you thought wewe ndio kiongozi huko, wewe ndio kusema. But kwetu ukikuja tunakuambia hapa Kubwa Limited kuja polepole. For every 2 that you have come with, we shall give you 1 share. So it is for every 2 shares that you have, there is 1. So it is 2 to 1. Sawa sawa. Hizo zako mbili tutakupea moja. So what are we doing? We have reduced your share by half. That is what we have done. So the exchange ratio there is a half. You know, you need to understand this thing in a layman language. So our exchange ratio is a half. For every 2 that you have, we give you 1. Tumepunguza by half. You are going to forgo the others. Why? Because uko na shida mingi. So huwezi kuja kwetu uanze kusumbua. Because if you have more shares in Kubwa, you're going to have more voting rights. You're going to have more revenues as income. Now, thank you. Now that you understand. So that is what happens. Now, that exchange ratio is very important for us as Kubwa Limited because it will determine how much shares we're going to take from those shareholders wakikuja kwetu. So that is why we are saying now, when you are now looking at the post-acquisition, EPS, this one is earning per share after the company has been acquired. Remember what we said, that the fact that it's acquired does not affect the operation. It does not affect because the management are still proceeding with operation. The only thing that we are changing is the ownership. So income will remain. So income for 1, company 1 plus 2, the 2 companies combined together will be the new total income. That will be the total earnings. So earning for 1 and earning for 2 will be our total earnings. All over, when we count number of shares, the number of shares in Kubwa Limited has not been affected. That one was not touched. Haijaguzwa hata kidogo. But for Ndogo Limited, which is now number of shares in 2, hapo ndio sasa imeguzwa. For every shares that you had in 2, ukivuka tuna split by a half. Tunakupea 2 moja. So you multiply that with the exchange ratio. Ndio ujue ni shares ngapi amekuja nazo ama amenunua hapa. Haizi kuja zikiwa full. So if there were 1 million, amevuka na tukasema exchange ratio here is a half, then it means that the only shares that we shall recognize as an increment is a half of 1 million, which is now 500,000. And that is why we are now saying that the 2 million that we are having here plus the total number of shares in 2 times the exchange ratio, which now gives us the 500,000. Hii ndio tunaongeza hapa. So we have 2.5 shares. We don't want to dilute because alternatively we could have accepted the old shares tukue na 3 million. Na hiyo 3 million tukigawa na hii pesa kidogo, kila mtu atapata kidogo kidogo. Remember we are having here revenue like 25 million. So tukigawa hii pesa itakuwa kidogo. It will have been 8.3. But now if we agree on a certain exchange ratio, we are going to have 25 divided by 2.5. Our new exchange ratio should be 10 million. 10. 10 is good. Why? It is making us retain the old EPS that we are having. We are talking about the EPS. Ile EPS tulikuwa nayo kama kubwa ilikuwa 10 na wale walikuwa na 5. Sisi after exchange we still expect to retain ours ama even tuongeze. Lakini tumemanage to retain 10. Therefore, if you have the exchange ratio, which is the best, we have agreed on the best exchange ratio, which we call the maximum exchange ratio, it will allow us to retain. And if you retain, it is our happiness kwa sababu hatuta lose anything. Yes, hiyo exchange ratio ni yenye wali agree. These guys watasema sisi tunataka hii. Na nyinyi pia mnaangalia hesabu, mnafanya hesabu, tunasema hatuwezi kubali hiyo. We shall agree on this. The one that Kubwa Limited is proposing, they should propose the one that cannot allow them lose. At least wabaki vile walikuwa in terms of the earnings for each share, 10 shillings, instead of losing. If they are going to take all the shares, na hii ikuwe 3, walete hii ikiwa 3 plus 2 itakuwa nini? 1 million plus 2 million itakuwa 3 million. Their earning per share will be 8. Lakini waki agree on a certain ratio, they accept the shares but at a certain ratio. That ratio should allow them to retain or even gain. If they retain, that is a maximum exchange ratio or non-diluting exchange ratio. So post-acquisition EPS. Are we together here? Henry, Edwin, Ruth, post-acquisition EPS is the EPS of the 2 companies. It is the earning of the 2 companies all over number of shares of the first company bila kuguzwa plus number of shares of the second company times the exchange ratio. And this exchange ratio here, for it to give us the maximum, then that exchange ratio should also be non-diluting exchange ratio. Otherwise, ikiwa tu exchange ratio, ikiwa tu a normal exchange ratio, it is going to give us normal post-acquisition exchange ratio. So tuko na exchange ratio after acquisition mbili. The first exchange ratio after acquisition can be the one that does not allow dilution. That is non-diluting exchange ratio. That one you must multiply the number of shares here with the non-diluting EPS or maximum offer price or whatever. If the one that you're going to get here is the highest, then exchange ratio should be non-diluting or what you call the maximum exchange ratio. Waziri hatuna question hapa. First company is the one acquiring or being acquired, yes. Now it depends. You need, from the statement, you should be able to understand which one is acquiring who. Wanaweka Kubwa Limited is the one that is acquiring Ndogo Limited. But sometimes they can have Ndogo Limited limetangulia alafu Kubwa Limited iko hapa. What will guide you? What will guide you is a statement. They will tell you a statement. Waziri, wewe nitakubali uongee. Wewe nitakubali uongee. Wacha waziri ongee nisikie vile. Waziri, hebu uliza hiyo swali vizuri.
Asante mwalimu. My question is, umesema there are some shares hapo haziguswi, yeah? The other ones you will accept on the ratio. So that's the question. I understand, of course, from the question you'll be able to know which one is the first or the second. But I was just trying to say which ones are you now trying to divide as per the ratio? Is it the one you are acquiring or the company that is being acquired? That's the question.
Yes.
So kama umenifahamu.
The one that is being acquired, the one that you mark like the ratio.
Okay, so the company acquiring zile shares hazitaguswa, si ndio?
Yeah, itaguswa. Number one, because shares zake hazikuwa na shida. There is no change on their share. There is no reconstruction. It is the one that is being acquired that tunajaribu kununua kampuni alafu tuna accept the shareholders. So when we are accepting them, we have now to tell them, for every 2 that you have or for every 3 tutakupea ngapi ukikuja kwetu. Hapo ndio sasa kuna exchange ratio. Lawrence has a question anasema, why is non-diluting exchange ratio has its own formula? As exchange ratio to has its own formula. Because non-diluting exchange ratio needs to help you get the best. So we have to have that guidance. 1 minute, 1 minute. Hello. Sorry, I'm back. Somebody was, when do we use the first formula and the second formula? Sawa. I like this kind of questions. Now, Lawrence, now, there is a situation where you're looking for just post-acquisition EPS. They are not asking you whether to give the maximum exchange ratio. They are not talking about that. Just the normal post-acquisition EPS according to the amount that they have agreed on. So if they ask you about that, then you need to know which exchange ratio did they agree at the time of acquisition. Wakati, unajua ukiambiwa post-acquisition meaning that they have acquired already. When they were acquiring, what did they agree on? That one will tell you the exchange ratio. So you need to know the exchange ratio. This is the only thing that you need to think about. Whether it was the maximum or it was an agreed. Unajua wanaweza kubaliana kwa price yenye sio maximum, and it can tell you that the price they agreed on is this one. Sometimes they can tell you the maximum offer price. So there are 2 prices. Kuna ile price wanaweza kubaliana, alafu kuna ile price inafaa wakubaliana. Ndio wahakikishe hakuna dilution. If you get the price that is the maximum offer price, that one will be able to give you maximum exchange ratio. So look at this. The examiner can be silent. If the examiner is silent, do it with the ratio that they given. So we have offer price here. Not exchange ratio. We have maximum, which we call non-diluting offer price. This one will be able to give you the non-diluting exchange ratio. No, maximum or non-diluting exchange ratio, sorry. This one you can get by having, ukiona tu wamesema non-diluting exchange ratio, non-diluting exchange ratio, know that the price that you're going to use here is not just a price, but it is the price of non-diluting offer price. And of course, who is offering this price? It is the price that the creditor is able to pay. So this one is being paid to Hiyo ndio bei predator anapropose anaweza lipa to the target. So it is normally for the target all over the MPS of the target. So we have non-diluting, non-diluting. Whatever exchange ratio you are going to get here, ukitumia hapa, then it means if you use this one here, then it means that this exchange ratio is going to make you now have the post-acquisition EPS when they had agreed on the maximum exchange ratio. EPS that you're getting, it is a EPS that has come as a result of the maximum exchange ratio, kwa sababu umetumia the maximum exchange ratio. But they can also tell you that the two parties have agreed to pay a certain amount. That amount might not be the non-diluting offer price. It can just be a price that they have agreed on. Therefore, what you're going to get, still, you can be able to get post-acquisition APS because they have agreed to acquire at a certain price. So the new exchange ratio, when they agreed on that price, which we call exchange ratio, you can say new exchange ratio. After they have agreed, it is just an exchange ratio, not non-diluting. It's just a normal exchange ratio. So it's just the offer price, which they will tell you. Don't care about whether it is non-diluting or not. Just take it all over MPS. This one is going to of predator. All over MPS of the predator. This one is going to be just a normal exchange ratio. Alafu unaiweka hapa. So when they have agreed on a certain price, you're going to have the new exchange ratio. That exchange ratio, it is the offer price that they have now agreed on, whether it is maximum or not, all over MPS. That is what you're going to use here. And in its post-acquisition EPS, you have to use that. You're going to have a new post-acquisition EPS. So kuna EPS after the offer price, maximum offer price, alafu kuna EPS on just a normal agreed value. Any question here, Florence? Thank you. Topista ametoka. Edwin. Milka. Najua umeingia sahi, but utashika, don't worry. Utashika, tumeenda kidogo, sio mingi sana. Haya, mimi sasa, I think we are doing well. Now you understand post-acquisition. You also understand non-diluting or maximum. You feel horrible. Lakini ndio umeingia, unastuka. Is it scaring you? Or you feel horrible? How? The next part that I want us to look at is the term premium. Juu ya kuchelewa. Sasa imagine kama ingekuwa physical class. Sasa hivi you will be sweating, unatetemeka, confused. Unapata Florence ameandika like 5 pages imepita or 4 pages imepita. But at least sasa hii you'll catch up. Kuna video. So online is the best. Vitabu inaanguka, hujui kalamu iko wapi. But now the beauty thing is that it's online. And the video you'll get, don't worry, you'll be fine. Now, the other term that I want to look at, Waziri, I hope that now we're okay. Ruth, I hope that you're okay. Ruth, can you confirm that we're okay? Please confirm that you're okay. You're following, thank you. So far everybody is at home.
Everybody's okay except Milka, and that makes sense. The other term that I want us to look at is premium. When we are looking at CAPEN, we say that premium is the difference between ERM and RF, right? So the difference between these and this, that is the premium. When you are looking at the EPS in your FR, when you're looking at the EPS in your FR, you also learned about selling shares at a premium and at a discount. Si ni kweli? Ama mjafika kwa hiyo topic? FR. And I should teach you that unit. So when you are selling shares at a premium, it means that there is par value. Kuna ile price inafaa ungetumia. It could have been 10 shillings. Lakini ukifika kwa market ukapata kuna demand, ukaamua kuuza at 12 shillings, a price that is higher than the value or the price you should have sold at. That difference between what you should have sold at and what you are now getting, if it is high, that difference is what we call premium. If you have gone lower, like now umeuza at 8 bob, then that 8 bob is now lower than what you should have sold at. That decrease is now called discount. Unaambia mtu badala ya kuchukua, si uchukue at 8 bob, ndio aone bei iko price ni bei ya jioni. Now the same thing happens here. The premium here comes in this way. We have the market price of Ndogo Limited. Remember, we are working on Ndogo kwa sababu Ndogo inachukuliwa. So we are selling Ndogo. Kuna ile share price that they could have agreed to sell at, which is 9 bob. Sindio? The shareholders wangekubali, wangesema, wangeamua waseme, instead of us being taken by Kubwa Limited in terms of share to share exchange, why can't we go to the market? Tuende tuuze, because the market price is 9 bob. Wewe sasa unataka tukuje hapa, we are going to lose. That for every share we're going to give you this. So you are trying to demean our shares. We cannot allow. If 9 bob is this, let's go to the market. Tunaelewana? So if they go to the market, if they get a higher price, they will be happy. Because in the market, they can sell at the market price, which is 10 bob. That is the MPS. But huku wanaambiwa different price. So the difference between these prices, if the offer price, the amount that Kubwa Limited is offering for them, please let us buy from you at this price. If that amount is higher than what they could have sold in the market, then the difference is a profit to them, because wangeenda kwa market wangelose. Sijui kama tunaelewana. Kubwa Limited wamekubali that we are going to buy you Ndogo Limited at 12 bob. But that is the offer. This one is what we call offer price. They have offered to buy at that price. Lakini pale kwa market price of the same Ndogo Limited is 9 shillings. Hawa wakileta mchezo, wakatai hii offer, wataenda kwa market na wauze at 9 shillings. Because that is the current market price, the EPM, the MPS. Lakini wakikubali wachukuliwe na huyu at this price, that is the offer price, it will be 12 bob. So the premium is what they have gained above, what they have received above the market price, above what they could have sold at. Hiyo ndio tunaita premium. So therefore, you can now say that premium is equal to the offer price, what is being offered, which is now like now 12 bob, minus MPS, market price of target. What target could have sold its shares in the market? Premium is the offer price over MPS of the target. So the examiner can ask you total premium. Total premium. Anaweza amua tu akuulize what is total premium. Hata kuambia hii ati premium kwanza, anakuambia tu total premium is equal now premium, because this is market price per share. So even this one is overpriced per share. So it is premium per share, which you can calculate here, which can be triple times number of shares in ndogo, or number of shares of target. Because their shares are going to gain. The shares should have been sold at 9 bob, the total shares that they have. But sasa tunauza at 12 bob. There is a gain of 3. That is a gain for each share. So if they sell at 12 bob and they gain 3 bob, what is the total number of gain? The total amount of gain. It is the total gain. It is now 3 times the number of shares of target. It is saying that in the first explanation, it was maximum exchange ratio, which is now relating overpriced, lower MPS of the predator. Currently, it was MPS of target. Now, which is which? So, Edwin, are you talking about the normal exchange, or you're talking about? But currently. So currently, I mean that you're talking about what we are handling here currently. When you mention currently, which currently are you talking about? Is it this currently? Na kama ni currently, hapa I've not even talked about maximum exchange ratio. I mentioned clearly that we have 2 types of exchange ratio, and I want you to listen carefully. We have 2 types of exchange ratio. There is maximum exchange ratio, which is associated with the maximum offer price. If there is no maximum offer price there, the exchange ratio that you're trying to calculate is just a normal exchange ratio. Even that offer price, it is offer price of the target. We don't have offer price of the predator. It is the predator offering to the target. It is the price of the target. So ukiona hapa MPS of target or lower MPS of predator, that is just a normal exchange ratio. Lakini ukiona ukisema maximum exchange ratio, then now you need to have maximum offer price. So we have 2 types of exchange ratio. Kuna the one that is non-dilutive, the one that will make them remain afloat without dilution. And then kuna ile tu wameagree gentlemen, wacha tuuze hii kitu at this price. That one is the normal exchange ratio. Of course, it is not MPS of just MPS of the target. It is now the offer. If they have agreed on a certain offer price, it's now the offer price. One thing that I want to understand that MPS is just market price per share. That is in the market currently. That will give us, before agreeing on any amount, the normal exchange ratio, whether we are going to lose or not. The normal exchange ratio is MPS of target, which is the price. It's just the price of target. Price of target all over MPS of the creditor. This one is going to give you a normal exchange ratio without caring whether it is the maximum or not. Now, if we want maximum, and we are very specific that now we want the maximum, then even this price should be now the maximum. So hakuna confusion hapo. So we are now talking about maximum exchange ratio is equal to the maximum offer price which is the same as non-diluting offer price na nilisema vizuri non-diluting or maximum and maximum, they have to match all over MPS of the predator. Remember, this one is for target, even if I don't mention target. Alafu kuna situation sasa, this is the normal one. Alafu this one is maximum. Alafu kuna situation where we have agreed, they agreed Wameamua sasa, wacha tukubaliane hapa. Kuna ile ulipata kwa market, kuna ile maximum, alafu kuna now they agreed. The agreed can be either higher or lower, but they have agreed on that. The agreed is the same as after, it is also the same as exchange ratio, but now it is on offer price that they have agreed on, not the price that was in the market. It is now offer price which they have agreed on, all over MPS of the creditor. Me, I don't know how else I can explain this. Maybe I now give you more videos to watch, but I know that with this explanation, you should be safe. So I'll repeat for the last time. In exchange ratio, there are 3 types. The first one is the one that you find in the question, which you can simply calculate and get. In case they have agreed to, in case they wanted to go with the market price, that one will be the market price all over this. EMPS is just the same as the offer price according to the price in the market. Lakini, the buying company can say that why can't you sell at this price without considering whether it is the offer, it is the maximum or not. That one is now the new offer price. They have agreed on a certain amount. That is not the one prevailing in the market, and it is not the maximum. Wamekubaliana tu, gentlemen. Wacha nikupee hii. Forget about the market. I don't mind about the maximum. That is just normal. It is still price of the creditor. Hata hii ni price of the creditor. But now when they are looking for the maximum exchange ratio, they have to use the maximum offer price. So the term maximum is associated with the maximum. Kama haina maximum, achana nayo. Hiyo utapata tu offer price, but not maximum offer price. So there is another question here. Hiyo premium ya ina compare na MPS. Understood. Florence, wewe hata swali ya Edwin nimeelewa, na wewe sasa una get confused tena. Na ulisema ushaelewa. Ulikuwa sawa. Edwin akiuliza, sasa hujaelewa, unauliza tena. Aki-understand, wewe sasa ume-understand. Where are you? Edwin ndiye alikuwa na shida, wewe ulikuwa sawa. Thank you. Now, let's now proceed. Okay, you are there. Thank you. Now, let's now get back to examples. I don't know which one I can use. I'm just feeling exhausted after that noise. I've really made noise to explain. But the good thing is that that is the main point in this topic. Tukifanya the next lesson, we are done with this topic, by the way. Hii tukimaliza, our next lesson is winding up. Just to wind up. So Berta, you're saying that umeamua kuelewa hii ya mwisho? No, bado utaelewa. Let me look for a question here. Tupambane nayo. I started the topic yesterday. Does it mean that yesterday you are not in? It was a Sunday. I want to write this one. Kindly copy this question. It is from December 2007, December 2007. I don't know kama waliset last year. Najua watu wanapenda kuset vitu za kitambo. Let me see what they set. Nani akona ile question ya last year? Last sitting, sorry. Ya last sitting. Maybe walileta kitu kama hiyo. FM ya last sitting. Inaweza kuwa walileta the exact one. Kama kwa WhatsApp kama kuna hiyo question. December. Mimi naipenda. Nikiona question kama hizo nazipenda sana. Walileta. Walileta. Hao watu. Najua watu walitetemeka hapa. Kubwa Limited. Imagine 207 December. Waka change figure. So read what they are giving you there. As you listen to what I'm giving you. 207 December, the question was that Kubwa Limited is considering acquiring Ndogo Limited through a share exchange, share to share exchange. Under the terms of acquisition, Kubwa Limited will offer one of its shares in exchange for every 2 shares in Ndogo Limited. Under the terms of acquisition, Kubwa Limited will offer one of its shares in exchange for every 2 shares in Ndogo Limited. What is the exchange ratio, Waziri? Up to there. Listen to what I'm saying. Kubwa Limited will offer one of its shares in exchange for every 2 shares in Ndogo Limited. What is the exchange ratio, Waziri? Walileta tu kitu kama hiyo. Acha nione. What is the exchange ratio? Muted. Thank you. Umeelewa. Unajua ni tamu sana. Ukianza kusoma question unaielewa, yani inaingia. How can the exam be difficult? To summarize the summarized financial information, mimi nasoma ya 207. The summarized financial information relating to 2 companies for the year ended 31st this November 2007 are as follows. We have Kubwa Limited and Ndogo Limited as they are there. Profit after tax is 150 million, 30 million respectively. Number of shares 25 and 8 million. Earning per share is given as 6 and 3.75. Market price per share is also given. The price earning ratio is given. The earnings per share of the combined companies required. The earning per share of the combined companies. Then they are saying that if the share price earning ratio after the merger falls to 12, what will be the premium received? What will be the premium? Florence, listen. What will be the premium received by the shareholders of Ndogo Limited? Who receives the premium? The shareholders of Ndogo Limited. Kwa sababu hawa ndio wanauza shares using the combined company's new share price. They are giving you a new share price. If the share price ratio after the merger falls to 12, will the merger be beneficial to the shareholders of Kubwa Limited? I want to share that question on WhatsApp so that you can take them down very fast. Class inaisha saa 2. No, sio saa 2, saa 4, sorry, saa 4. Ati saa 2. Saa 2 na ilipita kitambo. So let me share this question. Ubaya nikiacha ikiwa katikati hautaelewa nikirudi next time. So I don't know. So that is the question. And another one. Now, Florence, are you seeing why I would want to do as many revisions as possible? These guys go back to 207 to set you questions. Sasa, the more you do, the better. Haya. Should we proceed ama tuachie hapo? Sina question screen, weka kwa group. You took 4 hours doing jail. But you revised within this paper on your set. I realize most of your examples in Akuja. So tuachie hapo. And kama tunaachia hapo, make sure that next time when we come, usikuwa umesahau. Hebu fanya hiyo ingine, hiyo ya 207, hiyo number 2. That was June 207. Nimetuma the first one and the second. Everybody saying tuachie hapo. At least moja. We can continue tomorrow. Fanya swali at least moja. So Milka anasema tufanye hesabu moja. Which one do we do? Tufanye hiyo the second one that I've shared. Na hii ingine ilikuwa rahisi. So this one is the corporate tax given kubwa doing considered financing. Another question. Non-diluting maximum exchange ratio, the post acquisition earning per share. Hizi sasa ni familia. Ruth, hizi ni familia. Watu wamekuwa wakali hapa. I'll do one question. And then I'll do more next time. So, let me check which one to do. I want to do a simple one. Just a simple one, just a very simple one. Ndio msisahau. Nikiacha tu mtasahau. So the question says, the one that we are doing, the one that we're doing is a question for December 2017, June 2017, question number 5. I've shared on WhatsApp. I'm going to read it for those who will be using the video. The question says, Listen carefully. The following information relates to Alpha Limited and Beta Limited. As at December 31st, 2006, we have Alpha Limited and Beta Limited. The average annual sales is given like that. The average annual sales are given. We have 700,000. No, 700 million. That is the average sales, and 80 million. We have 75 million and 8 million. That is the net income after tax. Earning per share is given. Market price per share is also given. So let me just put it on the board for those who will be revising. So this is the information that we're given. We have Kuba, not Kuba Limited. This one is Alpha Limited. Alpha Limited. And then we have Beta Limited. We can call it B. Beta Limited. Then we have annual average sales. Now average annual sales. Average annual sales. Average annual net income after tax. Then we have earning per share. Which we call EPS. Then we have market price per share. Which we call MPS. Now, we have 7 million, 700 M. Then we have 80 M. We have here 75 M. We have 8 M. This one is 80, this one is 8. Then we have 3. We have 2. We have 40, and also we have 19. They are saying that Alpha Limited intends to acquire Beta Limited. Waziri, I told you that they always direct you. Alpha Limited intends to acquire Beta Limited through a share exchange. The number of issued shares for Alpha Limited and Beta Limited were 25 million and 40 and 4 million respectively. So number of shares. So unaongeza hiyo sawa. Number of shares. We have 25 M and 4 M, right? Respectively. Required the maximum share exchange ratio that Alpha Limited should offer to the shareholders of Beta Limited. The maximum share exchange ratio that Alpha Limited should offer to the shareholders of Beta Limited without diluting the earning per share of Alpha Limited, without diluting the earning per share. So they want you to give the non-diluting offer price. So non-diluting offer price, is equal to There's something that I want you guys to understand first. That we are having EPS of the predator of target all over EPS of predator should be equal to MPS of target all over MPS of predator. Your formula like that. When you look at the exchange ratio, the EPS of target, so EPS of target over EPS of predator should be the same as MPS of target. So target equal to in both sides. That is, somebody has a question. Oh, Edwin has joined. So that is the formula that you need to remember. Who can tell me how we got the non-diluting offer price? How did we say it? What was the formula? How did we say it? What was the formula? I hope that you're having this one somewhere. Remember, this one was giving you offer price. No, exchange ratio. So if you're going to have the maximum exchange ratio, this one is just a normal exchange ratio. This one is exchange ratio. Exchange ratio you can get it through this or this. Maximum exchange ratio we say that it is the same as EP market price MPS of target. Sorry, it is the same as the one that I've given you. Maximum exchange ratio is equal to EPS of target over EPS of predator, which is the same as maximum offer price of the target over maximum or over MPS of target. Let me just repeat again. This one you are familiar with. See to the maximum offer price all over MPS of predator is going to give you a maximum exchange ratio. That maximum exchange ratio can also be gotten through this. If you can't get maximum offer price, in case the examiner has not given you the maximum offer price which you expected, you can use the EPS of target over EPS of predator. That can also give you the maximum exchange ratio. So apart from getting it through this formula, you can get it through this. So with this formula, we are trying to equate that EPS of target all over EPS of predator should be the same as maximum offer price of target all over maximum offer price of predator all over MPS, not maximum offer price, but market price of the predator. We can now make any of these the subject of the formula. Make any of these the subject of the formula. The maximum offer price is equal to this one times this So we have EPS of target all over EPS of predator times the NPS of predator. Meaning that hii tumeleta huku, tumemark na hapa, this one. So this alone is equal to this. What we're looking for is now the maximum offer price. So maximum offer price is equal to EPS of target over EPS of predator times the NPS of predator. Naona kuna a lot of charts hapa. Now the question is not wrongly set. The only thing is that I gave you this, Jen. I gave you this in your notes. Check. I gave you this, but I didn't give you this one. So what I'm saying is that there are two ways of calculating the maximum acceleration. Maximum acceleration, not just acceleration, but the maximum acceleration. You can either have EPS of target all over EPS of predator, or maximum offer price of the target all over NPS of predator, which I gave you earlier. So you can equate this one to have either of these the subject to the formula. Depending on the information that you're given, if you're given EPS for each and NPS, but this one is not given, you can be able to calculate your own maximum offer price. So maximum offer price is EPS of target all over EPS of predator times NPS of the predator. Florence saying that the question is wrongly said no, because there is no maximum offer price. No, they want you to get the maximum offer price. Florence, when you are not given maximum offer price, you can calculate it by using this one. The maximum acceleration can be gotten through this or this. So if all these, the two formulas can give you maximum acceleration, then you can equate them. You can say that now this one and this one are equal. Therefore, you can make the maximum offer price the salary formula, and then you get it using that. So without being given here in this question is okay. You can calculate your maximum offer price. So now we can calculate it here. Our maximum offer price. It is the offer price that cannot dilute the shares. So it is equal to our EPS of the target. EPS of the target is, where is the target? This is the target. Still, it is now 2 all over 3 times MPS of the predator, which is 40. In that case, you are getting 26.66. Huh? Is it 26.266? That is the maximum offer price. That is how you calculate it. So that concept is very important, this one. And I like the fact that Milka has requested that we do that. Imefanya nimekumbuka that this part was left out. Jen, remember what I've said. Maximum offer price, maximum acceleration, sorry. You can get it by having the EPS of target all over EPS of predator, or you can also get it by having the maximum offer price. This one. All over MPS of predator. The maximum offer price all over MPS of the predator. So either use this or this. Both of them will give you maximum exchange ratio. And that is why we are able to equate them. When you equate them, you now say that EPS of target all over EPS of predator is equal to maximum offer price, not MPS. If you're looking for maximum offer price, maximum exchange ratio, you don't just have MPS, but you have maximum offer price or lower MPS or predator. Remember, this one is price of target, but it's the maximum, not the market price. It's the maximum price of target. It is the MPS of predator. So this is target, predator, target, predator. Ukishika hii, the way I've given you earlier here, you are better off. So that is the first part of the question. I don't know what the examiner asked. Let me just read the question again. The maximum share exchange ratio that Alpha should offer. So they want you to have non-diluting exchange ratio. How do you get non-diluting exchange ratio? So Florence was saying that the question was wrong because we could get the maximum offer price. Now we have calculated maximum offer price. So non-diluting exchange ratio, and Edwin, check your notes. Non-diluting exchange ratio is equal to maximum offer price all over. What did we say? All over MPS of the target, sindio? And we said that we have, this one is the same as maximum, non-diluting exchange ratio, and then offer price. And I repeated that non-diluting. So this one, you either use this formula or use this one. It is still going to give you the same thing, I believe. So what is the exchange ratio? MPS of predator. Target, sorry. Jen anasema nimechoka. So it is still going to give you the same thing. So Florence, you either use this to get the maximum exchange ratio or this. Hapa ukitumia hii, it is easier. You're going to have 2/3. Ukitumia hii, you should also have 2/3. Calculate, ujaribu, utapata ni the same. Are you getting that? Just take 26.666, weka into 4 decimal places, alafu divide by 40. What are you getting? 26.67 divided by 40. Because 40 is the MPS. What do you get? Same, 2/3. Then I divide by 19. This one is just MPS. It is not the maximum MPS. In MPS 2, we are talking about the maximum price, not just the price. So what they required there was very simple. You either use this formula or use this. I prefer using this kwa sababu hii ni direct. Hii ilibidi kwanza ukalculate ujue maximum offer price ni gani, ndio sasa ukalculate upate hii. The exchange ratio is just 2/3 to 1. So it is 2/3 to to 1. What does that mean? For every 1 share in target, si target iko hapa, this target, na hii ni predator. For every 1 share in target, anapewa 2/3. That is the exit ratio. For every 1 share, anapewa 2/3. Kama ingekuwa 0.5, then you say 0.5 to 1. For every 1 share in target, anapewa 0.5, which is a half. Hapa ni 2/3. So every 1 share anapewa 2/3. The other part of the question inauliza aje. So that is the ratio. They were asking about the ratio. The one that they should offer to ensure there is no non-dilution. Use this formula. The other part is that the premium that the shareholders of Beta Limited will receive using the share exit ratio. What is the premium that they can receive? We have seen the offer price using this exit ratio. Using this exit ratio, hakuna exit ratio ingine tumepewa ni hii. So if they use this exit ratio, what is the premium? We say that premium is offer price, whatever offer price. Premium is equal to offer price minus NPS of target. Clear? Because it is the shareholders of target Beta that are going to get. So it is 26.67 minus how much do they sell at 19? Kama wangeenda kwa market direct, wangeuza at 19, but sasa wanauza at 27. So 19. What do you get? Na hiyo iko sawa juu ulikuwa umesoma hiyo. Let me calculate that. It's 26.67 minus 19. 7.67. 7.67. That is per share, isn't it? Because this one also per share. 7.67. So if you're told the premium that they will get, you say it is this one per share, but now the total premium is we agreed is equal to 7.67 times number of shares here. Times 4 million. What is the total? Are they having 3 or 4? 4 million, eh? The total is 30. Ndio. We are done. Let me check if there is any question that we have not answered there. We are told that 4 million, yes. Number of shares is 4 million, so multiply there and get 30.68. 2.68. That is the total, but for 1 share is this. If they ask you for the premium that the company will get, shareholders will get, the shareholders will get, they are asking you for the total premium. Get the premium per share, multiply the number of shares, and you're okay. That question was simple. Time imefika. We shall do one more lesson. In that lesson, we shall do like 3 or 2 questions, and then we are done with topic 4. We end the topic 5 and 6, and we will be good. So on Wednesday, we are finishing topic 4. Saturday and Sunday, we are done with topic 5, if possible. The other week, end of next week, we should be done with topic 6 and 5 and 6. So Milka, don't miss classes, eh? We still have 6 minutes remaining. Wewe uko na nguvu. Wewe uko na nguvu, hujachoka. Ndio. Watu wamechoka hapa. Watu wamechoka hapa vibaya vibaya. That 6 minutes is not enough to do another question. So allow us to stop there. Lakini mtajaribu hii question sasa. The one that I've given you plus E. So we are not doing it. So those who can quit can just quit. We are not doing any questions. So Kubwa Limited is considering acquiring acquisition of Ndogo Limited, a firm in an unrelated line of business in order to diversify their risk. Selected financial state data shows that we have sales, cost of sales. Si ndio nilianza nayo. So what are they doing? They have given you information so that you can also calculate your net profit. So we have sales, cost of sales unatoa hapo, operating cost unatoa, finance cost, number of issues. So when you minus all these, you are going to have profit before tax. Sales minus all this profit before tax. Tunaelewana? Now you tax it so that you can get profit after tax. Because you are told that tax is 30%. So they want you to calculate your own tax. Waziri tuko pamoja? Waziri hapa hapa. Waziri, you simply take the sales minus cost of sales minus operating cost minus finance cost. Utapata profit before tax. You tax it, then you get now profit after tax. That is what we call earnings. Na najua hapo kuna watu waliona vumbi, waliona hii kitu wakasema kwani hii ni FR ama hii ni nini? They are just telling you, can you just do it your own? Number of shares is given, MPs are given. Then Kubwa Limited is considering financing the acquisition of Ndogo Limited using share-to-share exchange or debenture. Non-releasing maximum. This one is easy. They want you to calculate EPS. Maybe I feel like doing this, but let me just go home. Post-acquisition EPS and then EPS assuming we shall do that when you're now using debentures. Just do it where to do it. Wanadanganya watu, sio? Have a good night. Stop there.